Right. Let's jump straight into the deep end today.
Okay.
We're tackling, well, one of the most complex topics, but also, I think, rewarding ones in global finance, launching private equity funds, specifically in Luxembourg.
The big one.
Exactly. So if you need a fast, strategic guide to understanding the options, the timelines, and really why everyone flocks there,
Why Luxembourg? Yeah.
then you are definitely in the right place for this deep dive.
That's right. I mean, Luxembourg has really sort of cornered the market on being this premier launchpad for European investment funds.
It has.
So we've basically distilled the source material to give you that strategic roadmap. We'll detail the key vehicles, the structural choices, and that fundamental trade-off.
Speed versus oversight.
Speed versus regulatory oversight, exactly.
And the scale of this is just immense, isn't it?
It really is.
We're talking the second largest investment fund hub globally. Only the U.S. is bigger.
Yep, around 5 trillion euros in assets under management.
And the leading public finances domicile in Europe. So why should you, the listener, really care about that sheer size? What's the signal there?
Well, that scale, it's basically the proof of concept, isn't it? It signals global trust, efficiency.
Okay.
Investors are drawn there because of a whole synergy of factors. First, you've got that unwavering political stability, financial security, and that highly prized AAA rating.
Rock solid foundations.
Absolutely. And second, Luxembourg was a founder member of the EU. So they operate under these frameworks, particularly AIFMD.
The Alternative Investment Fund Managers Directive.
Precisely. Which are rigorous, yes, but they're also designed specifically to help capital move across borders.
So it's not just a safe place to put capital, but a safe place to move it from.
Exactly.
Which makes that concept of passporting just critical.
Absolutely essential. Those existing passporting rights under AIFMD mean a fund set up in Luxembourg can essentially be distributed pretty readily across the entire EU bloc.
Wow, that's a huge advantage.
Massive competitive advantage. And think about it, Luxembourg funds, they're sold in over 70 countries.
70.
It makes it the undisputed leader in fund distribution. No question.
Okay, so that really sets the scene for the where. Now, let's quickly define the what's for someone maybe prepping for a meeting on this. What exactly is private equity, PE, and how is it different?
Right. PE funds, they focus really exclusively on investing in the equity of privately owned companies.
Right, not public stock.
Not public stock.
Yeah.
And their horizon is long-term. It's quite different from, say, earlier stage funding like seed or pre-seed VC.
Also capital, yeah.
PE usually comes in after those initial VC rounds, often targeting, the late stage pre-IPO growth phase of a company.
And they're looking to actively improve the business.
Exactly. Implementing operational changes, trying to maximize value before they eventually look for an exit, like an IPO or a sale.
Got it. Now, setting one of these funds up, this is where the strategy really kicks in. Our sources point to this critical choice, supervised versus unsupervised funds. What's the kind of core difference there?
The core difference really boils down to that trade-off we mentioned, speed versus regulatory assurance.
Okay.
Supervised funds, well, the name says it all. They need lengthy pre-approval from the regulator, the CSSF.
The local regulator, yeah.
Whereas unsupervised funds, they deliberately bypass that product pre-approval step. The whole point is rapid market entry.
And Luxembourg offers both routes.
Uniquely, yes. It offers vehicles for both paths, and these can be structured as either tax-free or taxable, depending on what the specific investors, the LPs, really need.
Okay, timelines. Give us the contrast. How long are we actually talking?
It's pretty stark. An unsupervised framework, like an SCSp we'll get to, can potentially be ready in, say, 2 to 3 weeks. Blazing fast.
2 weeks. Wow.
But if you go for a supervised structure, like a SIF, that timeline stretches out significantly. You're looking at anywhere from 1 to maybe 4 months, sometimes longer, depending on the complexity.
1 to 4 months versus 2 weeks. Big difference.
Huge. But, and this is a really critical bottleneck, it often catches people out.
Uh-oh.
Regardless of how fast the vehicle itself is set up, opening the necessary bank account. That often takes a full month on its own.
A month just for the bank account. Why?
It's down to the intense global KYC Know Your Customer and AML anti-money laundering requirements.
Sure.
Banks are under huge pressure.
Right. So that's the universal drag on the timeline, no matter what structure you pick.
That's often the practical reality, yeah. A crucial insight.
Okay, that decision speed versus oversight.
Yep.
It leads us straight into the 4 main vehicles used for PE and Lux. Let's start at the top. If your main goal is institutional comfort, maximum regulation, What's the premium choice?
That would definitely be the SIF,
Yeah.
the Specialized Investment Fund. The SUF is a fully supervised entity. It's typically reserved only for what they call well-informed investors, basically professional or very experienced ones.
So pension funds, insurers.
Exactly. Those big institutional players often prefer the SUF precisely because the CSF, that's the Financial Sector Supervisory Commission, conducts direct product-level oversight.
They check the fund itself.
They do. And it requires extensive standardized reporting. Plus, it's pretty flexible structurally. You can set it up as an umbrella fund with multiple sub-funds inside. Quite modular.
Okay, so SAF is the gold standard for oversight. Why then would a fund promoter ever choose something faster, maybe less regulated? What's the fundamental gain?
Speed, agility, market access, and often they'll choose the RAIF, the Reserved Alternative Investment Fund.
RAF. Okay, how does that work?
Well, the thinking behind the RAF was pretty smart. It recognized that for many investors, the real value, the real oversight they trust, lies with the manager, not necessarily the fund vehicle itself.
Ah, interesting distinction. So it's a kind of hybrid approach.
Exactly. The RAIF itself is an unregulated product. That means it skips that lengthy CSF pre-approval process for the fund.
Faster time to market.
Much faster.
Yeah.
But, and this is the crucial bit, it's Alternative Investment Fund Manager, the AIFM.
The manager running the show.
That entity must still be fully CSSF supervised. So you're essentially outsourcing the regulatory burden, or rather the direct oversight, to the manager level.
Clever. So you get the credibility of a supervised manager, but the speed of an unregulated product.
That's the idea. You get market access faster.
Yeah.
But you absolutely must have an authorized AIFM and a depositary appointed for RAIF. Those are mandatory.
Okay, that's a really interesting blend. But if we're talking pure, unadulterated speed and flexibility, maximum contractual freedom, which vehicle takes the crown?
That would have to be the SOP or SCSP, the Special Limited Partnership.
SLP, SCSP.
That's probably one of the most strategic moves Luxembourg made, really tapping into global familiarity.
Yes.
They essentially adopted and adapted the partnership model that everyone already knew from the US, the UK, the Cayman Islands, you know, the classic general partner, limited partner structure.
Wait, so they didn't invent some complex new European thing. They just imported a legal structure that fund managers and investors worldwide already understand.
Pretty much. And that familiarity is a huge part of why it's so popular.
That sounds like a massive advantage for cross-border deals.
It is. The main benefits are, 1, speed, you can genuinely be up and running in 2 to 3 weeks.
Incredible.
2, massive contractual flexibility. Everything's really governed by the limited partnership agreement, the LPA.
Yeah.
And 3, it's generally tax neutral and requires no prior regulatory product approval.
Okay, but hold on. If the SCSP is, as you say, an unregistered, unsupervised AIF structure, how does it get that really valuable European passporting right we talked about earlier? Seems like a contradiction.
Good question. It achieves passporting through delegation.
Delegation.
The SCSP itself isn't regulated at the product level, but it can gain the passport if it simply appoints a CSF-regulated AIFM to manage it.
I see. So the AIFM brings the passport.
Exactly. That process of appointing the AFM and getting it registered might take about a month, give or take. So the flexibility stays with the partnership vehicle itself, but the distribution power, the ability to market across the EU to professional investors, comes from the regulated manager.
Very neat. Okay, fourth vehicle. Where does the SICAR fit into all this? Is it even a fund structure?
Good point. The SICAR, Société de Participation Financière, is less of a fund structure and more of a powerful commercial holding company layer.
A holding company?
Yeah. It's become really the favored vehicle for structuring cross-border PE deals, especially complex ones involving multiple countries. You see sovereign wealth funds, big corporations, family offices using SOPIFIs a lot.
Why them specifically?
Mainly due to structural advantages, particularly robust access to Luxembourg's network of double tax treaties. That's a major draw. It does require a minimum share capital deposit, EUR 12,000.
Got it. Okay, let's shift gears slightly. We've talked about choosing the vehicle. Now let's talk execution. Investor confidence really hangs on solid governance, right?
Absolutely critical.
Let's break down those 4 key governance roles you need in place. Seems essential for getting banks comfortable too.
Definitely. Quality governance drives bankability and investor confidence. So these roles ensure accountability and protect investors. First, the AIFM.
The manager again.
The manager again. The brain of the operation, really. They handle portfolio selection, risk management, and they are absolutely pivotal for EU distribution via the passport.
Okay. Rule number 2.
The depositary. Think of them as the asset safekeeper. Their job is to safeguard the fund's assets, monitor all the cash flows, and make sure everything's properly segregated and accounted for.
Keeps everything secure and transparent. And the other two, administrator and auditor, they sound like the operational backbone.
That's a good way to put it.
Yeah.
The administrator handles the crucial NAV calculation determining the net asset value per share or unit.
How much the fund is worth.
Exactly. And they maintain the investor register, often managing communications with the limited partners, handling subscriptions, redemptions,
All the admin.
all the crucial admin. And finally, the auditor. They provide that independent external assurance on the fund's financial statements. They check that the valuation policy is being applied correctly and fairly.
So those 4 pillars, AIFM, depositary, administrator, auditor, they create the necessary trust framework.
Precisely. It's a well-defined ecosystem.
Okay, makes sense. So let's imagine you, the listener, you've defined your strategy. You've picked your vehicle, SEF, RAIF, SCSp, maybe using a superfi layer. You've started appointing these governance providers. Let's map out the practical steps from there. What's next?
Okay, so steps 1, 2, 3 are strategy, vehicle choice, appointing providers.
Okay.
Step 4 is really about drafting the core legal documents.
The paperwork.
It's more than just paperwork. It's the legal operating manual. We're talking the LPA, the limited partnership agreement for an SCSp, or the equivalent constitutional docs. This defines everything: fees, carried interest, governance rules.
The fine print matters.
Hugely. Plus the specific fee schedule, the detailed valuation policy. You need airtight documentation or things grind to a halt very quickly.
Right. And step 5, onboarding. This sounds like where those friction points, like the bank account delay you mentioned, really come into play.
It's often the most critical and, frankly, the slowest phase in practice. Step 5 involves managing the actual investor subscriptions, completing really robust KYC/ML checks on every single investor.
Know your customer, anti-money laundering.
Yep. And crucially, gathering concrete proof of the source of funds for every bit of capital coming in.
And Luxembourg's regulators are tough on this.
Very rigorous. Their sophistication means they demand absolute clarity. Any whiff of opacity, any inconsistent documentation, and progress stops. Dead.
Okay. And then finally?
Finally, step 6 is ongoing operations and reporting. That means actually managing the fund day to day, making capital calls from investors, managing the investments themselves, distributions, and fulfilling all those ongoing regulatory reporting obligations, like under AIFMD.
It's a continuous process.
Absolutely. Launch is just the beginning.
This brings up one last really strategic piece: tax. You mentioned Luxembourg offers both taxable and tax-neutral vehicles. How do the actual tax outcomes typically differ based on the vehicle chosen?
Yeah, the tax side is crucial. It really hinges on 2 things.
Yeah.
The specific fund regime you choose and the overall architecture, like whether you use holding companies.
Okay.
So for those highly flexible, often partnership-based vehicles like the SCSp, you generally benefit from fiscal transparency. Meaning the vehicle itself isn't taxed. The tax liability, income, or gains flows through directly to the investors in line with their home jurisdiction rules. It's tax neutral at the fund level.
Got it. And for the supervised one?
For supervised vehicles like the RAIF or the SEF, they aren't transparent in the same way. Instead, they typically pay a small annual subscription tax, the taxe d'abonnement, calculated on their net assets. It's usually quite low, but it's there.
Okay, so transparent versus a small levy.
Broadly speaking. But the real sophistication comes in the structuring around the fund. Using holding companies, maybe a SOPRFI like we discussed, or other special purpose vehicles.
Why do that?
To optimize things, to potentially benefit from Luxembourg's participation exemption on dividends and capital gains, to maximize access to those double tax treaties for cross-border investments, and critically, to make sure you comply with all the latest anti-hybrid rules and base erosion and profit-shifting BEPS measures.
So it's an intricate game of architectural planning.
Very much so. The tax structuring is just as important as the fund vehicle choice itself.
Okay, let's try and pull this all together then, bring it home for the listener. The core takeaway seems to be that Luxembourg offers this really sophisticated, multi-layered toolkit. And the fundamental choice boils down to this. Do you prioritize pure speed and maximum flexibility, which points towards maybe the SCSp or SLP model?
Right, the partnership.
Or do you prioritize institutional comfort, deep regulatory oversight, which maybe pushes you towards the SIF, with the RAIF sitting somewhere cleverly in between.
That's a great summary of the strategic decision, yes.
Yeah.
Speed and flexibility versus embedded oversight.
Now, if we connect this back to the bigger picture
Yeah.
you mentioned, and the sources highlighted, what often causes delays is friction in the system. Things like opaque ownership chains, messy documentation slowing down bank accounts.
Exactly. The practical hurdles.
So here's the thought to leave everyone with. Luxembourg is this massive global hub, #1 for distribution. How does that constant drive we see for structural flexibility and speed? How does that square with the equally intense, maybe even growing global need for super transparent KYC and AML processes?
That's the tension, isn't it?
Is there a fundamental conflict there? And what does that friction really mean for the future of trying to do finance quickly, efficiently across borders?
A really compelling question. How do you maintain leadership in both efficiency and compliance? That's the challenge Luxembourg, and indeed global finance, faces going forward. Something definitely to mull over.
Indeed. A perfect place to wrap up this deep dive into private equity structuring in Luxembourg. We hope you found that useful. Go reflect on those strategic concepts.